This is not the first time you are doing this topic. You must have done it before. So let me first remind you, before we develop the topic, let me first remind you what you used to do in this topic of cash flow. You remember this, that whenever you are required to prepare a cash flow statement, you are required, as a company, you are required to classify your cash flows into 3 categories. Whenever you are required to prepare a cash flow statement, you know, because we are not doing it for the first time, you must have done it before. We are saying you are required to classify your cash flows into 3 categories. The first category is what you used to call cash flows. This is what you used to call cash flows from operating activities. Don't write cash flows from operating activities. So you are required to identify. The cash flows from operating activities. Once you identified all of them, of course you remember, some of them could have been positive, some of them could have been negative, whatever the case might be. But you are required to identify the first category of cash flows is the cash flows from operating activities. Identify all of them. We shall look at that later. Once you identify the cash flows from operating activities, you have to get the net of all of them. I've said some of them are positive, some of them are negative. Get the net of all of them. Once you get the net of all of them, push that figure to the extreme. Push that figure to the extreme. That figure could either be a positive amount or it can be a negative amount. If it's a positive amount, we used to call it net cash inflow from operating activities. If it was a positive, you call it net cash inflow from operating activities. If it was a negative, you call it net cash outflow from operating activity. That was the first class of the cash flows. That is cash flows from operating activities. You had to go to the second class of cash flows, and that's what you used to call cash flows from investing activities. Cash flows from investing activities. Again, as a company, you are required to identify all your cash flows from investing activities. Again, some could be positive, some could be negative, as we shall look at that later. But for now, we are just assuming some of them are positive, some of them are negative. Once you identified them, you had to get the net of all of them. Whatever is the net, again, you have to push it to the extreme. That net amount would again be either a positive or a negative. Let us assume for now, ours became a negative, meaning the negatives were more than the positives, so you get a negative net effect. Okay? So if it's a negative, you had to call it net cash outflow. You had to call it net cash outflow from investing activities. Net cash outflow from investing activities. That was the second class of your cash flows. That is cash flows from investing activities. Then you had to go finally to the last class. That was the cash flow from financing activities. Cash flows from financing activities. Meaning you had to identify again. You had to identify your cash flows from financing activities, whatever they were. Identify. Again, some of them could be positive, some of them could be negative, whatever the case might be. Once you identified your cash flows from financing activities, you had to get the net of all of them. Whatever is the net, push it to the extreme again. Let me assume this time you got a positive amount. If it's a positive, you used to call it again net cash inflow from financing activities. Net cash inflow from financing activities. That's how you have to identify your cash flows. Start with the cash flow from operating activity. Go to the second class, which is cash flow from financing. Go to the third, cash flow from investing. Then you go to the third category, which is cash flow from financing activities. Now, listen. Once you identified those three categories, you had to get the total. You had to get the total of the three categories. The total of the three categories, meaning get your cash flow from operating, whatever you got from your operating total, whatever, add it to the investing, whatever you got as your net from investing, then add it again to whatever you got as the financing. Get the totals of those three categories. Get the total. Again, that total would either be a positive or a negative, because if some are negatives, then you could have ended up having a positive. Let us assume that you get a positive amount. Let us assume you get a positive amount. Once you get a positive amount, that is what you used to call increase in cash and cash equivalent. Increase in cash and cash equivalent. So if it was a positive, you called it increase in cash and cash equivalent. If it was a negative, you had to call it decrease in cash and cash equivalent. Decrease in cash and cash equivalent. Okay? Then from there, you had to add, I'm just reminding you, you had to add what you used to call opening cash and cash equivalent. Opening cash and cash equivalent. Of course, you remember, listen, of course, you remember, every time the examiner used to give you a question on cash flow, he had to give you an income statement for that particular year, and he had to give you a statement of financial position, what you call balance sheet. One balance sheet for last year, and you are given another balance sheet for this year. When I say down here that we are adding opening cash and cash equivalent, meaning whatever was the closing cash and cash equivalent last year automatically became the opening cash and cash equivalent this year. Okay? So by the beginning of this year, whatever was the closing last year became the opening. That's why we are calling it opening cash and cash equivalent. Once you add the opening cash and cash equivalent, get the total down there. That's all. That total is what you used to call the closing cash and cash equivalent. The closing cash and cash equivalent. Meaning, listen, meaning therefore, because you are given the balance sheet last year and the balance sheet this year, whatever figure you are getting here as the closing cash and cash equivalent, that should be the exact amount in the balance sheet for this year as an amount of the cash and cash equivalent. In other words, we are trying to reconcile what was the closing cash and cash equivalent last year with the closing cash and cash equivalent end of this year. So the figure you get down there, which we are calling cash and cash equivalent, should be the same as this amount you are given in the balance sheet of the end of this current year, which you are doing. Okay? So I've reminded you in general how you used to prepare, how you used to prepare a cash flow statement. You had to start with the cash flows from operating activities, then go and identify the investing activities, then identify the financing activities, then get the totals of the three categories. It's a positive, I've told you, call it increase in cash and cash equivalent. It's a negative, we have said you call it decrease in cash and cash equivalent. Okay? Then I've said you get the closing cash and cash equivalent. Now, we want to go back and look at each category now, how you determine or how are you determining the cash flows from operating activities. How are you determining the cash flows from operating activities? That's again something I want to remind you. Now we want to remind ourselves, how do you determine the cash flows from operating activities. Now, but before we discuss how to determine the cash flows from operating activities, you need to know when we say we are looking for cash flows from operating activities, what do we mean? What do we mean when we say we are looking for cash flows from operating activities? Now, when you are doing this topic the first time, the teacher must have told you what are operating activities. You could not have done cash flows without defining what are operating activities. And so to remind you, we normally say operating activities are those transactions and events that are used in the determination of profit, or the transactions and events that are used in the determination of profit in a business. Those transactions, we normally classify them as operating activities. So we want to find out from all those kind of transactions which are normally used in the determination of profit, how much was the actual cash flow from all our transactions that we undertook this year as a company, which are from operating activities. How much cash flow did we generate them? Now, to identify the cash flows from operating, I've told you operating activities are those transactions that are used in the determination of profit. Okay? Meaning, if you prepare your income statement, let me assume you prepare your P&L account in a T format. If I prepare my P&L account in a T format, not the vertical one, the T format, you know, on the debit side of that P&L, we normally put expenses and any expenditures. Then on the credit side, we normally put any revenue and incomes. Okay? Then you normally compare the expenses and the incomes, and you will normally get the difference to represent the profit for the business. Let's call it this as the net, to be what you can call the profit before tax. For now, let me assume your company has a profit before tax of 100 million shillings. Okay? Now listen. It means therefore, listen carefully, we are looking for the net cash flow from operating activities. I have said operating activities are those transactions that are used in the determination of profit. Okay? Now, so having got this 100,000, I've compared the incomes and the expenses. I've compared the incomes and the expenses. Now, meaning, listen carefully, meaning therefore, it is generally, or you can say in general, therefore you can say that your net cash flow, net cash inflow from operating activities should be that 100 million, which is the profit before tax. I have said, get the operating activities. What are operating activities? Are those transactions and events that are used in the determination of profit. I've said, to get profit, we normally compare the expenditures or the expenses with the incomes. Don't forget, we are looking for the net. All the categories, you have to look for the net amount. Okay? So we are looking for the net cash flow from operating activities. Now, listen. That is to say, in principle, we could conclude that this 100 million represents the net cash inflow from operating. Why? Because you have already compared the expenditures, not the incomes on the credit side, and the expenses on the debit side, and you've got the difference of 100 million. So in principle, you could say that 100 million represents your net cash inflow. But is it true that that 100 million represents the actual net cash inflow from operating? The answer is no. that 100 million is not actually the true net cash inflow from operating. Reason being, before I give the reason, we could say this. If everything in the P&L account, was by cash, both on the debit or on the credit side of the P&L, if it was by cash, then you could conclude that the 100 million is the net cash inflow. The 100 million is the net cash inflow. If everything in the P&L was by cash, then you can conclude that 100 million is the true net cash flow. But we all know that in the P&L account, not everything that goes into the P&L account is normally by cash. No. There are some items you could have debited in the P&L account which are not cash items, but the rule of accounting says you debit them in the P&L account. There are some items you could have credited in the P&L account which are not by cash, but the rules of accounting says you consider them as gains or incomes. So now we are asking ourselves, listen, because not everything in the P&L account is by cash, how much therefore, listen to the question now or to the concern, how much therefore should have been the true profit if everything in the P&L account was by cash? If everything in the P&L account was by cash, what would have been the true profit? That which would have been the true profit then would now represent the net cash inflow. So to get this net cash inflow from operating activity, you had to, this is a reminder, you had to get the profit before tax, whatever it is, which in my case I'm assuming to be 100 million. Then, listen now, then I adjust it with the few items that are in the income statement which are not by cash. Adjust that P&L profit with the few items which are in the P&L account which are non-cash items. So we normally adjust the profit before tax with all the non-cash items. Maybe I could give you one example. We all know, for example, when you depreciate your motor vehicle or your furniture or building, we normally debit that depreciation in the P&L account, whatever is the depreciation charge for the year. But is it true that you paid that amount for depreciation? Was there any cash involved? The answer is no. There was no cash involved as far as that depreciation amount is concerned. And we are looking for, but we are still looking for, what would be the true cash? What would be the true profit if everything in the P&L account was by cash? So we say, this 100 million, which is the profit before tax, what would it have been if depreciation was not among the P&L items? If depreciation was not among the P&L items, what would have been the true profit? The true profit would have been, is it more than it should be or less than 100 million? We argue this way. Listen, we argue this way and say, by including expense called depreciation in the P&L account, if it was not there, then my expenses would have been less. As far as cash flow is concerned, not P&L. P&L was not wrong. But as far as cash flow is concerned, we are arguing this way. That this item in the P&L account called depreciation, as far as cash flows is concerned, it must have made the expenses to be overcasted from the cash point of view. From the cash point of view, the expenses are overcasted because of that one non-cash item called depreciation. So if it was not there, would this profit be more than 100 million or less than 100 million? It's obvious. Listen, it's obvious that when expenses are overcasted, profit is normally undercasted. When expenses are overcasted, profit is undercasted. So to adjust this profit, you will now come and add that depreciation. You will now come and add that depreciation charge. Whichever is the depreciation charge for the year, you add it back. And so we are saying, identify from your income statement, identify such non-cash items. So I want you to write me on the chart and give me a few other examples of expenses which normally go to the income statement, which are non-cash items. Put it on the chart. Give me a few more examples of expenses you know, which are not cash items, but they normally go to the P&L account. Debited the P&L account with an expense or an item, but yet it is not a cash item. So that we use it to adjust this 100 million we are classifying as our profit. Somebody chat, give me an example, chat and give me another example other than depreciation. What other example of non-cash items do you have? Good. Ben is giving me impairment loss. Good. Good. Let me continue with that now. Now, when you impair an asset like goodwill, for example, we don't depreciate goodwill. We impair goodwill. Okay? So when you impair an asset like goodwill, then that impairment loss of that asset is not a cash item that you paid. Yet you debited P&L account, with that item called impairment. So by including it in the P&L account, you made the expenses more than they should be from the cash point of view. So again, when we are doing our cash flow, you come and say, what effect did that impairment have on the profit as far as cash flows are concerned? It will be argued that expenses were overcasted, profit was undercasted. So to correct it, you add back that impairment loss. Good. So somebody give me another one. Impairment loss. Give me another one. Good. Give me another one. Give me another example of a non-cash item that normally goes to the income statement, yet no cash was paid. Give me another example of a non-cash item. Not really. Fair value gain. Let me explain to you. Let me explain to you. Let me explain that so that I don't explain it later. So Ben is saying fair value gain. That could be what you mean by revaluation gain, or it could be revaluation loss. Now, listen, Ben. Listen, Ben, I want to explain that because it's a common mistake that students give as an example of another non-cash item. They say either revaluation gain or revaluation loss. Now, when you have an asset, let's call it land. Assuming you have a land as a company, which is at a value of 100 million. Then during the year, you revalued that land. And maybe you revalued it upwards or even downwards, whichever the case. But let us assume you revalued it upwards. So you must have debited, when you revalue an asset and you are revaluing it upwards, you must have debited that asset. Let us assume you revalued it by 20 million. You must have revalued it by 20 million. You debited the asset by 20 million. And you must have credited an account called revaluation reserve. That's what you did. Debited asset and you credited this account we normally call revaluation reserve by 20 million. Okay? Then come the end of the year. Listen, come the end of the year, you close the accounts. So you carry down this account called balance carry down, revaluation reserve, 20 million. Where did you take it? It went to the balance sheet as a component of equity. It went to the balance sheet as a component of equity. Now listen, this 20 million, is it an non-cash item? Yes, that's a fact. It's an non-cash item. But, listen to this Ben now, but the question is, as much as it's true it's an uncashed item, is it affecting what I am adjusting? Remember, the rule of double entry does not say that you debit asset and you credit P&L. The rule does not say you debit asset and credit P&L. It says you debit asset and you credit revaluation reserve. Then the balance in the revaluation reserve goes direct to the balance sheet. It goes direct to the balance sheet. It does not go through, listen, it does not go through the P&L. No. But what are we doing? We are trying to ask ourselves, what would have been the true profit if everything in the P&L account was by cash? And so the reason is, we don't use the gain or loss on revaluation, as much as it's true it's an uncashed item. We don't use them in the cash flow statement as an uncashed item. Why? Because is it affecting my 100 million profit? Is it affecting 100 million profit? The answer is no. It's not affecting our profit. Why? Because it never went through P&L. We debited the asset, yes, and we credited revaluation reserve. Then come the end of the year, it went direct to the P&L account, to the balance sheet, sorry. It never went through P&L. If it went through P&L, then we could argue and correct this 100 million. But because it does not affect, listen to this, because it does not affect the profit in the P&L, then don't use it to adjust this 100 million in our cash flow statement. Why? Because it's not affecting the 100 million. We are looking for those items in the income statement which are non-cash items, meaning they affected the profit. But if something is an uncashed item and it never affected the profit in the P&L, then don't use it. Are you there, Ben? Hope you have managed to understand the reason now. I'm saying you're not the only one. Most students sometimes confuse and say gain or loss on revaluation. But we normally don't use it in the cash flow statement as much as the reason, as much as it's true, it's an uncashed item. I hope you have understood now. You chat and say yes or no. Then, hope you have understood why we are not going to use it here. Good, thank you. Sawa. Now we proceed. So we are only looking for those non-cash items in the P&L. So do you think of another one? Can you think of another one now? Are you able to think of another non-cash item? There are so many. Listen, there are so many expenses that normally go to the P&L which are non-cash items. Listen, I'm not asking you to remember these items as per your knowledge of cash flow. I'm even asking you to remember them as from your knowledge of an accountant. When you are preparing an income statement, not even cash flow, when you are preparing an income statement, what are some of the expenses that normally go to the P&L account, yet no cash was paid? There are so many. Somebody give us another one. There are so many. Other than these two that we have quoted, there are so many others. Other than these two that we have quoted, there are so many others. Yes. Chat and give me another one. Unrealized gain or loss. Okay, fine. Good. Unrealized gain or loss. That's true. That's true. Accruals, no. We shall talk about them later. Regina, accruals, we shall use them later. Unrealized gain or loss. Yes, if it's a loss, you add. If it's a gain, you minus. But not a common one. Not a common one. There are even some which are mostly common. Unrealized gain or loss is not common, but there are still others which are common. Dividends, no. Dividend we paid when we are paying financiers. Dividends we pay to the financiers. It does not go to the P&L account as an expense. It's an appropriation of profit. Listen, dividend is an appropriation of profit. So it does not affect this figure we are calling profit before tax. It is an appropriation which comes later. Are you getting? I'm only asking those items that affect these 100 million. Dividend is an appropriation of profit. Are you okay, Regina? Compensation for stock loss, for damaged stock. Good. Okay, fine. That's another good item. Loss on damage of stock. I don't know why you are giving me the unique ones. You're not giving me the most common ones. You're giving me the unique ones, but I'm looking for common items. It's true, when there's stock loss, that's another non-cash item. But I'm looking for the common ones. I don't know whether you have exhausted them. I pick up from there. Oh, yes. Okay. Let me give you another one as you think of another one. Now, among the other non-cash items you normally put in the P&L account is provision for bad debts. Provision for bad debts. When you as a company, you anticipate that some debtors are likely not to pay you, you are required to provide for that expected loss. When you anticipate that some debtors are likely not to pay you, you are required to provide. That's a rule of accounting. So you provide for the loss by recognizing that anticipated loss. So you must have debited P&L account with that provision bad debts. But is it something you actually paid for? The answer is no. Just an accounting rule. It says when you anticipate that some of your debtors are likely not to pay you, make a provision. So again, it's another non-cash item. So among other non-cash items, provision for bad debts, again, it made my expenses more than it should be from the cash point of view. It made my expenses more. What do? I correct that by adding it back. It made my expenses more. By making my expenses more, it made my profit less than it should be. So we add back that provision, bad debts, whichever it is. Now listen, let me add you another one. Even the bad debts themselves, not provision only, even bad debts. When you write off a debtor, when you write off your bad debtors, you normally debit bad debts account and you credit debtors. Then come the end of the year, you transfer the balance of the bad debts account to the P&L account as a loss. That amount of the bad debts written off, it's not something you paid. It's just a bookkeeping entry. You have to recognize a loss when you make up bad debts. Saying, when you write off any of your bad debts, that is another non-cash item. So it made your expenses less than it should be. Made your expenses more than they should be, cash point of view. So what effect did it have on the profit? Made your profit less than it should be. Come and add your bad debts. You come and add the bad debts, whatever it is. Good. Let me add you another one. When you amortize your intangible assets, for example, copyrights, trademarks, and others, intangible assets. Whenever you amortize your intangible assets, that amortization is an expense. But is it that you paid for it? Again, the answer is no. You didn't pay for it, so you come and add back that gain. That is what we are calling amortization. That's what we are calling amortization. Whatever it is. Good. Now, let me give you another one. Now, when you as a company, you have a motor vehicle or furniture or building, let's assume it's motor vehicle. That motor vehicle had a net book value of 10 million. You sold that motor vehicle for cash of 8 million. Sold the motor vehicle for cash of 8 million. It is obvious you must have made a loss of how much? 2 million. had a book value of 10 million in your company, sold it for 8 million. So as a business, you made a loss of 2 million. That loss on disposal is not something you paid. No, it's just a bookkeeping entry. You took it to the P&L account as a loss among the expenses. So as far as cash flows is concerned, again, that item made your expenses more than it should be, and therefore you come and adjust it by adding that loss on disposal. You add loss on disposal, whatever it is. Now, listen, suppose you sold it for 18 million now. There's a book value of 10 million, but you sold it for 18 million. As a business, you made a profit now of 8 million. You made a profit of 8 million. That 8 million, listen, it's not something you received. What you received is 18, not 8. But what you took to the P&L account, as a gain on disposal, on the P&L account, you took it as a gain of 8 million in the P&L account. You took a gain on disposal of 8 million. That gain is not something we received in cash. Yet, listen to this now, yet we used it to determine our profit before tax. So as far as cash flow is concerned, this gain on disposal made now our profit more than it should be. It made our profit more than it should be from the cash point of view. It made our profit more than it should be. Therefore, we are saying, listen, because the gain on disposal made your profit more than it should be from the cash point of view, and yet don't forget, we are looking for the true profit if everything in the income statement was by cash. What effect did the 8 million have? Argue by saying, made our profit more than it should be as far as cash flows are concerned. So as far as the cash flows are concerned, made our profit more than it should be. So when it's a loss, a gain on disposal, we shall be subtracting any gain on disposal. Any gain on disposal, whatever it is, minus. Okay? Now, let me add you another one. And the next one is what we call finance cost. I expected you to give it to me. You add what we call finance cost, whatever it is. But let me explain it. Let me explain it so that you understand why finance cost is a non-cash item. But to explain it, I want to challenge you by giving you a question. Because this is something you must have done in your financial accounting. When you are doing financial accounting of the beginner's level, you must have done this. In that beginner's level of accounting, you did a topic called company accounts. In that topic of company accounts, you used to be given a trial balance. In that trial balance, you used to be given something like 10% debentures. Let us assume 500,000. Then in the same trial balance, you used to be given something like interest on debentures. Let's say 40,000. Assuming that's all for the trial balance. Listen, then you are required to prepare an income statement or a profit and loss. You are required to prepare profit and loss. Now tell me this. When you are required to prepare profit and loss, tell me this. In that P&L account, how much were you charging as interest? Look at that trial balance. You are given that as your trial balance. In that trial balance, you have a 10% debenture at 500. That trial balance, you have interest on debenture amounting to 40,000. Then you are told, prepare an income statement or P&L. The question is this: how much were you charging? Because this is not something new. How much were you charging as interest in the P&L account. Somebody to chart. How much? If you are given a trial balance of this nature and the examiner tells you to prepare an income statement, the question is, how much do you charge in the income statement as interest? How much were you charging? This is not something new. It's just a reminder. Yes. Vincent says 50. Correct. Now let me explain it. So when you are given a trial balance like this, every year from this trial balance, listen, your company was supposed to pay back the debenture holders. Every year, they're supposed to be paid back at interest of 10%. So 10% of 500,000, every year, the company is supposed to pay them an interest at 10%. 10% of 500,000 is 50,000. That's what you normally charge in the income statement. So when you are preparing an income statement of a business, listen, we don't prepare by charging expenses of what you actually paid. If you look at this trial balance, we actually paid 40. But when you are preparing an income statement, you don't charge 40. Why? Because I hope you still remember that when you as a company are preparing your income statement, you normally follow a concept called accrual concept. What does that concept state? The concept states that you recognize costs when they are incurred. You recognize costs when they are incurred, but not when money is paid. You recognize costs when they are incurred, but not when the money was paid. We have paid 40,000, meaning that you still owe the debenture holders 10,000. That 10,000 is what you used to take it to the balance sheet. Here, you used to take it to the balance sheet as a current liability, and you say your interest owing 10,000. But according to the trial balance, you have paid only 40. But you took to the P&L account the charge for the year. The charge for the year. That's why we are saying the cost. You recognize costs when they are incurred, but not when money is paid. Are you there? Good. Now, therefore, listen, therefore, you as a company, you charged 50,000 to the P&L account. But did you actually pay 50,000? No. You only paid 40. But 50 went to the P&L account. Which means that was just a bookkeeping entry. Not something you paid by cash, the amount of 50. It's not something you paid by cash. Just a bookkeeping entry. So meaning, therefore, among your non-cash items, listen to this now, among your non-cash expenses in the P&L account was the 50. Not the 40, the 50 that you charged. That 50 we are calling interest, which went to the income statement. That 50 which went to the income statement as interest is what you charge. But it's not what we paid. So we normally consider, listen, we normally consider that interest charge, we also call it finance cost. We normally consider it as another non-cash item. That 50, utaitumia in your cash flow statement. That 50, you will have to use it in the cash flow statement. That 50,000. It's another non-cash item. Listen, we have seen you only paid 40. That 40, listen now, that 40, utaitumia among the financing activity. You paid the financiers called debenture holders, you paid them an interest of 40. Whenever you pay interest or returns to financiers, whenever you pay a return to financiers, we normally classify that payment to the financiers as a financing activities. So among your cash flow items, in your financing activity category, there you will now have that interest paid how much? 14. I hope you are getting. It's obviously a negative because it's a negative. You paid it. Now listen. Hope you have understood. I have to repeat because this is something you should understand, because every question would come with this item called finance cost. Every question you will do will come with it. Yeah? Listen. I have said, whatever you charge in the P&L account as interest, which in our illustration here is 50, that is not what you paid. You paid 40 from our illustration. But when you are doing the income statement, you took the charge for the year, which was 50. So that 50 that you took to the income statement, we have said, it's not something you paid. It's just a bookkeeping entry. What you actually paid was 40. So the 50 you took to the P&L account, being a just bookkeeping entry, it's classified as an uncashed item. It's classified as an uncashed item. Then I've said, listen, whatever you actually paid, which in our illustration is 40, that 40 is what you paid to the financiers that are called debenture holders. And anything you pay to the financiers, we normally classify it. Anything you pay to the financiers, we normally classify it as a financing activity item. That 40, you remember to use it where? In the cash flow statement among the financing activity items. You use it among the financing activity items. You there? Good. Now, listen. I go back because I want to emphasize something still more. Listen to this other question. Suppose, listen to this. Suppose you are given this trial balance. I'm robbing something from this trial balance. Suppose you are given that trial balance now. You are just given 10% debentures amounting to 500. In that trial balance, there is nothing like interest. There is nothing like interest in that trial balance. So, listen to this. Question is this. When you are required to prepare income statement, were you charging anything in the P&L account as interest? That's a question I want to ask you. Were you charging anything in the P&L account as interest? Yes or no? Somebody to help me answer there. Listen. You have a 10% debenture in the trial balance amounting to 500. From that trial balance, there is nothing like interest. Then the examiner used to tell you, prepare an income statement or a P&L. So the question is, in that P&L account that you were preparing, were you still charging interest in that P&L account? Question is, yes or no? That's what I want to see. Yes. Vincent says, yes. I hope you still know how much. From what I've already talked about, you should be able to tell me how much. How much, Vincent? Or Joshua? 50. Good. That one. That's correct. 50. Listen. This time, in that trial balance, you have paid nothing. You have paid nothing. So the whole 50, listen, the whole 50 becomes the charge for the year, and the whole 50 becomes the liability. It's an interest owing of 50 in the balance sheet. So you paid nothing. So you still owe the debenture holders the 50. You still owe them the 50. So in the income statement, you charge 50. Did you pay the 50? No. So still, listen, still, when I'm preparing my cash flow statement, I'm going to consider and say, are there any non-cash items in the account? The answer is yes. Which one? That finance cost, that interest charge for the year, 50. Listen to this now. So that 50, it does not matter whether we paid it or never paid it. It is the charge the year. The 50, the charge the year. Doesn't matter whether you paid it or you never paid it. Now listen. When it comes to financing activities, here, will you show now? The question is, listen, will you show any interest paid? Yes or no? In your cash flow statement among the financing activities, with this second illustration, will you show any interest paid? I want to see yes or no. In this second classification, good. Vincent says no. Thank you. So we are saying, listen, this time, as much as I charge 50 in the P&L account, from the same trial balance, I never paid anything. When it comes to cash flow of this company, this second case now, if I'm to prepare their cash flow, this time I am not going to show any interest paid among financing activities. I hope you're getting that. I'm not going to show any interest paid among the financing activities. Why? Because we paid nothing. We paid nothing. So there are times you may be given a question where you could have paid something, or there are times you could be given a question where you paid nothing. So as far as financing is concerned, listen, as far as financing section is concerned, there will be either interest paid or no interest paid. But as far as operating, that's my concern for now. As far as operating activities is concerned, the charge for the year was non-cash. The charge for the year was non-cash. Listen, let even me make it better. Let me even add it. Now, listen. Suppose even in the trial balance, there was interest on the debenture, 50. Listen. Suppose in the trial balance, there was interest on the debenture, 50. Would you still have, listen to this now, would you still have 50 as an non-cash item? Would you still have 50 as an non-cash item among the operating activities? The answer is yes. Listen, the answer is yes. That even if we paid 50 in the P&L, in the trial balance, among the non-cash items, you still must use the 50. Reason being, listen, when we were calculating or when we were preparing the income statement, whenever a company is preparing their income statement, to them it does not matter whether they have paid interest or not. They charge the year. How do you get it? 10% of the debentures. 10% of whether you have paid the interest or not. That's not the concern of the income statement. Whenever a company prepares an income statement, they recognize the charge. Not whether they have paid or not, the charge. So the 10% interest on the debenture, which is 50. When you are doing an income statement, that time you did not bother whether you have paid it or not. You just took 10%, 500, and you got it as 50. That's what you charge in the P&L. The P&L. Listen, for this time, in the balance sheet, you will show nothing as interest owing. Why? Because you have paid everything. You have paid everything, so you show nothing as interest paid, as interest owing. Meaning now, listen, meaning in the cash flow statement, hope you are following, meaning in the cash flow statement, among the non-cash items, that 50 will still be there. That 50 will still be there. And at the same time, among the financing activity, you will also have interest paid of how much? 50. It's a negative. Hope you have understood. You will still have interest paid because this time you actually paid. The financiers by the name of debenture holders, you will have interest paid of 50. So I've taken time to explain that concept of finance cost, which is what we are also calling the interest charge for the year. Now, coming back, listen to this. Coming back to the non-cash items here, I want you to remember this point. Anytime, listen to this point, anytime you are given a question of cash flow, among the non-cash items that will never miss in any question, 2 will never miss. 1 is depreciation. The depreciation charge for the year will never miss in any question. 2, the other thing that will never miss in any question is that finance cost. That amount of the 50. Whichever the amount will be as per the question, it will never miss. So 2 things I want you to remember: finance costs and depreciation. Among the non-cash items, they will never miss in any question that you have ever done. Even in the one you did in the beginner's level cash flow, they used to be there. What you will do, and even for what you will do in the future, 2 of the non-cash items will never miss: depreciation charge and the finance cost. For the others, like impairment, loss, provision for bad debts, amortization, loss on disposal, those others may be there or not there as per the question. These 2, don't forget, never miss. Which one? Depreciation, finance cost. Listen, the other key point I want you to remember is this. When it comes to finance cost, that 50, you don't have to calculate it. The examiner will give you the income statement for the current year. So from that income statement, obviously the examiner will have indicated the finance cost amount, 50 or 20, whatever it is. You just go pick it and put it there. What I'm trying to show, listen to this now, what I'm trying to show you is that whenever you're given a question of cash flow, there are 3 ticks you should never miss. 1 is the figure for the profit before tax. That one, you just go to the question given, P&L account or the income statement, pick that profit before tax. That's a free mark. 2, depreciation. You should remember it. Some questions give you the amount that was charged during the year. Some questions require you calculate it. That's okay. But don't forget, it will still be there. Whether you are going to calculate it on your own, the amount, or you will be given and told during the year the company depreciated their assets by 50 million, 40,000, 20,000, whatever it is. That's upon the question. The other figure I've said you should never miss, which is a free mark, is this amount called finance cost. Said it's a free mark because you just go pick it. Not something you calculate. It's given to you in the income statement. Good. Now, having identified, and I'm assuming those are all, I've only given a few examples of the non-cash items. Listen, giving you a few examples of the non-cash items. Once you identify those non-cash items, get the total of them. That means you take the profit before tax, add those items you have added. For the items you subtracted, like the gain on disposal, you minus, then get the total, whatever it is. Okay? Get the totals, whatever it is. That total, listen, that total would either be again positive, negative. Let us assume it's a positive. You call it cash flow before working capital changes. Cash flow before working capital changes. That's what you call that total. The figure, you have taken the profit before tax, you have adjusted with those non-cash items, get it, call it cash flow before working capital changes. Then you now come and incorporate the working capital items. Everyone knows what is working capital. Working capital, of course, you know, includes current assets and current liability. So the examiner will give you two balance sheets. Let us assume he gives you a balance sheet for the year 2024 and a balance sheet for the year 2023. Among the current assets, you have stocks, debtors, less cash, whatever it is. Let us assume stocks last year were 20,000. This year, the end of this year, stocks are 35,000. So you come and say, last year the stocks being 20, this year the stocks are 35. There was an increase in stocks. That's a change in the working capital items. Come back to your cash flow. I've said this is cash flow before working capital changes. You come and now say your increase stocks. Increase in stocks. Of course, for stocks to go up as a business, what could have happened? It is obvious you must have bought some more stocks. Stocks to go up as a business, must have purchased some more. So that's obviously an outflow. Cash went out. Then you go to the next working capital item, which among the current assets is debtors. Let me assume debtors last year was 40. This year it's 10. So this time we have a decrease in debtors. 40,000, 10,000. Come and say here, decrease in debtors. Decrease in debtors. Whatever it is. So the question is this. When debtors go down, what could have happened? If last year we were demanding 40,000 from our debtors, now come the end of this year we are demanding 10,000 from debtors. It is obvious they must have paid us. For debtors to go down, must have received debtors. Therefore, that change. So this is decrease, sorry, not debtors. This is decrease in debtors. This is decrease in debtors. For debtors to go down, we must have received. That is an inflow. That is an inflow. Good. Next, we have cash. Maybe cash was 10,000. This time, 20,000. Listen, do we come and say increase in cash among the working capital items? Do we say increase in cash? Somebody has already answered. No. Good. Vincent, thank you. Already said no. Why? Listen, I told you this. I don't know, I've wrapped it. When you added the three categories, operating high totals, investing totals, and financing, I told you the totals of those three categories, you had to call it increase in cash and cash equivalent. Then I told you, you come and add opening cash. This is opening cash and cash equivalent. That's what I told you. Then you get what we called closing cash and cash equivalent. Now, meaning, listen, meaning as much as it's true, cash is one of the working capital items, we don't use it among the working capital changes. We don't use it among the working capital changes. Why? Because cash and cash equivalent have their specific place when it comes to cash flows. Here down in the cash flow, come and say you're opening cash and cash equivalent. Go to the balance sheet last year. What was the closing last year? 10,000. At 10,000 is what I'll pick. I'll bring it here and add it as opening cash and cash. Is it 20 or 10? 10. Good. That's where it is. So for cash, listen, for cash, as much as it's true, it's a working capital item. maybe cash or money in the bank, we don't use them among the working capital items in the cash flow statement. Instead, we use it as part of the opening cash and cash equivalent. Hope you have understood that point. Good. So let me assume, let me assume I'm through with the current assets. Then I go to the current liabilities, the balance sheet. Among the current liabilities, let me assume we have creditors. Last year, the creditors were 15,000. This year, the creditors are 8,000. What could have happened? For creditors to go down, we also call them trade payables. For creditors to go down, we must have paid them. Last year, we owed them 15. This year, we owed them only 8. We must have paid them 7,000. That is what you come and now see here, decrease. Come and see here, decrease in creditors. Decrease in creditors. Come and see here, outflow. That's a negative. You there? That is a negative. Listen, for now, let me assume those were the only current liability. That was the only current liability. Once you do that, get the totals here. Get the total there. Meaning, get this cash flow before working capital changes. Add the increase in stocks. Increase in stocks. Add decrease in debtors. And you minus the decrease in creditors. Then you get the net, whatever it is. Once you get that net, then if you remember, you had to come and say less tax paid. Less tax paid. Whatever you paid this year as a company for taxes, minus. Listen to this now. Then whatever you get after minusing tax, that becomes the cash flow operating activity. Becomes the net cash flow operating activities. It could either be positive, as I said earlier, or it could be negative. So now let us assume it's a positive. You will call it net. Want to assume it's a positive, you will call it net cash inflow from operating activities. Net cash inflow from operating activities. Good. So you are now through. That is net cash inflow. If it's a negative, said you call it net cash outflow. A positive, call it net cash inflow. Good. That's all for the first category of the cash flows. Now let's go to the second category of the cash flows now. Go to the second categories of the cash flow. I'm assuming you have understood first category, and that's the most critical category. That is the category called the operating activity. That is the most critical category. Now we can go to the second category. That is the category we are calling cash flow from investing activities. Let's talk about that now. Cash flow from investing activities. Want to remind ourselves, what are some of the investing activities? I've said it's not something you're doing for the first time. Somebody's asking you, what if you have short-term investment among the current assets? I want to challenge you. I don't know whether to challenge you or not to challenge you, Vincent. It is possible. Listen to this now. Let me explain it. It is possible among your fixed assets, or what you can call non-current assets, it's possible to have investments. 2023, whatever the amount. 2024, whatever the amount. Then, among your current assets, you also have investments. Whatever the amount last year and whatever the amount this year. Now, both of them are investments. It's only that one of them is a short-term investment. The other one is a long-term investment. The question is, how do you treat them when it comes to cash flow statement? Now, before I answer that question, Vincent, allow me to continue a little bit. Before I answer you now, allow me to go to the second section first, slightly more. I'll talk about it slightly, then I'll answer you in the next 5 or 6 minutes from now. Now, let's continue for now, then I'll answer your question. So we are going to the second category now, which is called cash flow from investing activities. But now the question again is, you have to identify the cash flows from investing activities. But before you identify them, you need to know what are these investing activities. Saying this is not the first time you are doing the topic, you must have done it before. So you need to remind yourself, what were investing activities? What kind of transactions were these? Now listen. Investing activities are those transactions that affect any transactions that affect a fixed asset. That kind of a transaction. Any transaction affecting fixed assets. That kind of a transaction is classified as an investing activity. Example, when you purchase a motor vehicle, purchase a building, purchase furniture, those are fixed assets. And one example of an investing activity we could put here is what we could say purchase fixed assets. Whichever the fixed assets, whether you are buying a motor vehicle, you're buying furniture, or you are buying building, it's something that's classified as a fixed asset. Therefore, it is obviously an outflow. You are purchasing, cash went out. That's an outflow. Next, it could be you're also selling motor vehicle. You are selling furniture, selling a building. That's still a fixed asset. Or come and say your sale or fixed asset, whichever the fixed assets. Sale of fixed assets, whether you are selling vehicle, furniture, or building, still a fixed asset. This time it's an inflow. Okay? Listen to this now. I have said investing activities are those transactions that affect fixed assets. Investing activities are those transactions that affect fixed assets. If you look at this balance sheet, which I try to draw down here, hope Vincent is now coming on board. Among my fixed assets, I have investments. Let us assume last year the investments were 200,000. This year the investments are 300,000. So it is obvious for investments to have gone up from last year to this year, you must have purchased some more investments. And these are investments which are considered as long-term investments. They are among the fixed assets. So in your cash flow statement, among the investing activities, you will come back and say here, purchase of investments. We purchase investments for an extra 100,000. Put it here, 100,000. Last year our investments were 200. This year our investments are 300. We must have purchased some more by an extra 100. That is an outflow. Okay? Listen to this now. These same investments that you bought and classified them as investing activities, they could have given you some dividend income. during the year. Or if it's an investment, you put money in a fixed deposit account, maybe 5 years, wherever, it's a long-term investment. Okay? Bought treasury bonds, it's a fixed investment. Yeah? That investment would be giving you a return. Not paying, it's giving you a return, which we call return on investment. The investment income that you earn, listen, the investment income that you earn from your investments, that income should also be classified as an investing activity. Any investment income should be classified as an investing activity. You purchase more investments, or you had investments which are long-term investments, therefore you got income, those investments. That the investment income is classified as an investing activity. Don't forget, the investment income is not classified as operating activity. No. It is investing activities. I said operating activities are profits, are transactions or events from the normal operating. When you invest and buy shares in a company, that's not a normal operating activity of your business. No. Just an investment you did. So when say any investment income, don't forget, should be classified as an investing activity. Should be classified as an investing activity. Now, to answer Vincent now, what about short-term investments, which are among the current assets? Any short-term investment, listen, or in other words, any investment by whatever name they are calling it. They may not call it short-term investments. They may call it fair value investment here. Even for the fixed investments, or for the fixed assets one, among the fixed assets, they may just call it fair value investment. So it does not matter. What is important is under what category is it. If you have a short-term investment among the current assets, by whatever name they are calling it, whether they are calling it fair value investment or they are calling it trade investment, so long as it's among the current asset, listen, you consider it as a cash equivalent. As a cash equivalent. So when I was doing when I was doing the cash flows down there, I was saying, get the operating, investing, financing, get the totals, you remember? Then I said you add opening cash and cash equivalent. So it means now, if the short-term investment here was 10,000 and there was cash in the balance sheet, cash of 30,000, then it means my opening cash and cash equivalent, it's not 30. It means my opening cash and cash equivalent is not 30. It is 40. That's why we say cash and cash equivalent. So here we will bring in 40. So we normally say any short-term investment, I am answering question now to Vincent, sorry. Any short-term investment should be considered as a cash equivalent. So you combine it with any cash balance or any bank balance. Are you okay, Vincent, now? You have asked that question. What if you are given short-term investments? Are you okay with that now, Vincent? That any short-term investment among the current assets should be classified as a cash equivalent. Put it together with the money in the bank, bind it with any cash in hand, and that short-term investment. Say it by whatever name they are calling it. Good. So let's go back now. So we're still discussing the short-term, the investing activities. We're discussing the investing activities. Let's get the totals for now. Listen to me. I've said investing activities are those transactions that affect fixed assets. Give example like purchase of fixed asset, motor vehicle, furniture, sale of motor vehicle or furniture. And I've said any purchase of investment. And I've told you that investment is only the long-term investment, not the current. Good. And I've said if that investment gave you an income, that investment income from the investment should be classified as an investing activity. Any investment income. You okay now? Good. So for now, let me assume those were the only ones among the investing. Normally, there are not many. Let me assume those are the only ones. Get the net, push it to the extreme. For now, I want to assume the net is a negative. That means your negatives were more than positive. Good. That is the case. Then we call this one net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. Otherwise, if it was a positive, you would call it net cash inflow. If it's a negative, call it net cash outflow. Good. Then from there, you now go to the last category of the cash flows. That's what we call cash flows from financing activities. Cash flows from financing activities. Then you will identify the financing activities. Before we identify them, we need to ask ourselves, what are financing activities? Because you must have discussed this when you are doing the topic before, saying financing activities are those transactions. They are those transactions that affect finances. Financing activities are those transactions that affect finances. Example, you as a company wanted to raise more finances, you could have issued some shares to the members of the public. Come and say you issue shares. That's one example. Financing activity item. Also, company wanted to borrow finances, so you decided to issue some debentures. Good. Came and said your issue of debentures. That's an inflow. Maybe you had borrowed some finances in the previous years, form of loans, and maybe your loans are going down or they are going up. Let me assume the loans are going down. You could have what we call loan repayment. Loan repaid. Remember, you borrowed to finance loans. Have loan repaid, that's an outflow. Good. Listen again. Let me now assume again that these are the major financing items as per your balance sheet. These are financing items, maybe issue of shares, issue of debentures, and loan repaid. Then if you remember, I told you earlier, anytime you pay a return to financiers, anytime you pay returns to financiers, we normally classify that return as part of financing. When you pay a return to the financiers, example, the shareholders whom we borrowed by issuing by issuing shares, we normally pay them a return at the end of each year, or dividends. So dividends paid is classified as part of financing. Any dividends paid normally classified as financing activity item. To the loan providers, to the debenture holders, you normally pay them a return called interest. Or any interest paid classified as a financing activity. Interest paid. Whatever it is. Good. Assuming those are the only returns we paid, get the nets. Get the net from all your financing activities, push it to the extreme. Push it to the the extreme. Let me assume again all our financing activities were positive. All of them, assuming the net positive, so you call it net cash inflow from financing activities. Net cash inflow from financing activities. Then I told you, once you identify all the three categories of the cash flows, get the totals of those three categories. The operating activity I total, finance the investing total, and the financing total. Whatever you get the totals there. I told you that total could either be a positive or a negative. Okay? If it's a positive, I told you call it increase in cash and cash equivalent. Increase in cash and cash equivalent. If it's a negative, I said call it cash decrease, call it decrease in cash and cash equivalent. Then you come and now add opening cash and cash equivalent. Opening cash and cash equivalent. Where do you get that opening? Go to the balance sheet last year. As I told you, you'll be given two balance sheets, one for last year and one for this year. Go to the balance sheet for last year. Whatever was the closing cash, money in the bank, that's part of cash. I have told you, listen, I've told you any other short-term investment. So the cash and cash equivalent, listen, that figure we are calling opening cash and cash equivalent would comprise of three things. One, cash in hand, money in the bank, and any short-term investment. Some questions have all the three items in the balance sheet. Some questions may only have cash. Some may only have cash and bank. That depends with the question. Good. But you add the opening cash and cash equivalent. Then get the totals. That total, we call it closing cash and cash equivalent. Closing cash and cash equivalent. Good. I've shown you in general how we prepare cash flow statement. Shown you in general, maybe to just go through in an overview again. Say the first category of the cash flow. What's the idea in this interest paid? Because some books, it's treated as operating. Okay. Vincent, that's very true. Now, the accounting standard on cash flow, that is IS number 7. I am answering Vincent again. That accounting standard number 7 allows businesses or companies to treat the interest paid as either being operating or financing. If you decide you are going to consider it as part of your operating activities, the interest paid, not the finance cost, the interest paid, then you will bring it here. Among the interest, once you have the tax paid, among the tax paid there, you will have interest paid there. Whatever it is, if you treat it as operating, then it will work out after getting the working capital items, work out interest paid. Alternatively, the same accounting standard allows you to treat it as a financing. So the examiner will not mark you wrong wherever you put it. Either you classify it as investing, as financing, like I did, or you classify it as operating, as you're suggesting. It's still allowed. Some arguments argue that we borrowed, financed the operations. So interest paid is part of the expenses. That's okay. part of operating. Some argue by saying we are paying the financiers. And financiers, whatever you pay to the financiers is classified as financing. So there's those two arguments. Both of them are accepted. Borrowed, finance your operations. So finance cost is a cost of borrowing or financing your operations. Interest paid is a cost of operating, financing your operations. Fine. So you can classify it as operating activity. Or you can still classify it as financing activity depending on how you look at it. Are you okay, Vincent? Yes or no? Good. So you are allowed to treat it either way. That is specifically only interest. Otherwise, listen. Otherwise, all the other items you have no option. You have to remember where they go. All the other items. But interest, you are allowed. Either operating or financing. Okay? Good. So I was saying, I've reminded you how you used to prepare a cash flow statement for a company. Where you have said, or we have agreed, start with the category called operating activities. Identify the profit from operating activities. Get the profit from operating activities. Listen, we have said there are three. Take the profit before tax. Go to the P&L account that the examiner will give you. Identify the profit before tax. Then I've said adjust it with all the non-cash items as much as the question will allow you. Also told you, among the non-cash items you will never miss in any question, that is something you should never forget, is interest charge, which the question may call it finance cost. I've told you that's not something you calculate, it will be given the income statement. Just pick it. Okay? Good. The other thing I've said you will never miss in the question, as far as non-cash item is concerned, depreciation. I've also told you some questions you will be given amount. Some questions you may be required to calculate it if the examiner is hiding it. Other non-cash items, say, depends with the question. Impairment, provision for bad debts, amortization, loss on disposal, gain on disposal, all those are not a mandatory in all questions. Depends with the question. Once you identify the non-cash items, said you get the total, call it cash flow before working capital changes. Then bring in the working capital items. Those are current assets item, and current liabilities. Good. Get the totals, you minus the tax. Also minus the interest, like we have said. Get the total of all that, push it to the extreme. Come to the second category, that is cash flow from investing activities. That is any transaction affecting fixed assets. Case of fixed assets, sale of fixed asset, case of investment, or even sale of investment. Could be you're selling part of your investments, which are long-term investments. I've also told you, any return you're getting from your investments, which is investment income, should be classified as investing activities. Get the net, push it to the extreme. And I've said you come to the third category, that is cash flow from financing. Financing are those affecting finances, shares, debentures, loans. Once you have identified them, those could be the major ones. I'm not saying they're the only ones. Depends with the question. Then you now come to paying the returns, financials, form of dividends or interest, and get the totals, blah, blah. That's what we say. Now, this is one format of presenting a cash flow statement. Just want to remind you, you also remember that there are two methods of presenting a cash flow statement. There are two methods of presenting a cash flow statement. One of them is the one we have already dealt with. The two methods, one of them is called the direct method. One method of presenting a cash flow statement, we call it indirect method. And the second method is what we call the direct method. The one we have just dealt with is the one called the indirect method. So the question is this: what's the difference between the two methods as much as cash flow preparation is concerned? The difference between the two methods come in on the presentation of the section called operating. Otherwise, for investing section and the in financing section of the cash flow, it does not matter which method you are using. The two remain the same. When you are presenting the investing, it doesn't make the difference whether you're using invest or direct or indirect. The amounts are the same, everything is the same. When it comes to financing activities, it doesn't matter which method you are calling it, whether you are calling it direct or indirect, the amounts are the same. So the difference between these two methods only come in when you are presenting the section called operating activity section. So this method we have just discussed, where you got the profit before tax, then you came to adjusting non-cash items, working capital items, then you minus the tax paid. That is the approach we are calling the indirect method. I want to just remind you again, how do you present your cash flows from operating activities using the direct method? Now, when it comes to direct method, and you want to determine the cash flow from operating activities using the direct method, this second method is shorter. You only need 3 figures to get the cash flow from operating activities. You need 3 figures. One of them are positive, 2 of them are negatives. So I want you to remind me which 2. Let's put it this way first. You need that figure, you need the second one, you need the third one. Then once you do that, get the total. Then you come and see your tax paid, whatever it is, minus. Then you push the figure to the extreme, and that becomes your net cash inflow from operating activities. So you can see this method is shorter. It only requires you to give us 3 figures. So I want you to remind me, which are these 3 figures? One of them is a positive, 2 of them are negatives. Somebody to chart. Somebody to chart. Chart and give me 2 of those figures, or any that you can remember. Just remind me any so that I pick it from there. Yes. Any amount you can remember among the 3. Any amount that you can remember. Operating profit. No. This time you don't start with operating profit. No. Finance cost. No. Okay. It seems people have forgotten. Let me remind you. The first amount you have to calculate is called cash received from customers. You have to determine an amount called cash received from customers. I am not saying cash received from debtors. No. Saying cash received from customers. So as a company, you have to determine from all your customers, how much cash did we receive? Whether these are customers you sold goods to on credit, or they are customers you sold goods on cash basis to all, or no, from all your customers, how much was the cash received? So you determine that figure. Somebody can now get the second one? Are you able to remember the second one now? Are you able to remember the second one? Okay. The second item is what we call cash pay to suppliers. Cash paid to suppliers. To all your suppliers as a company. I have not said cash paid to creditors. I've said cash paid to suppliers. To all your suppliers. Those guys who you purchase goods from. Whether you purchased by cash or you purchased on credit from them, later you paid them. How much in total did you pay all your suppliers? Cash paid to suppliers. Get the amount. The third figure you need is what we call cash paid for services. Cash paid for services rendered. Cash paid for services rendered. Now, as a business, there are people who gave you service. So you need to know, to all the service providers, how much did you pay them? That's why we are calling it cash paid for services rendered. Employees gave you a service, you paid them salary. Kenya Power gave you a service, you paid them for electricity. And many others. The landlord gave you service for rent, you must have paid him rent. So on. So for all the services that were given to you, in other words, for all your expenses, in other words, the cost that you incurred in the running of the business, how much did you pay in total? Those are the cash you paid, services rendered. Now, listen. The only issue when it comes to this second method is that the examiner will never give you any of these three amounts. He will not give you how much is the cash received from customers. Normally, it's your responsibility to calculate it. The examiner will not give you how much is the cash paid to suppliers. Normally, it's your responsibility to calculate it. The examiner will never give you the cash paid for services rendered. Normally, it's your responsibility to calculate it. So that's the only tricky part out of this second method. That as much as it's shorter than the first approach, the problem here is you have to calculate the three figures. It's not like the first approach where we were identifying the cash flow from operating, pick the profit before tax, depreciation could be given, provision for bad debts could be given in the question, impairment could be given in the question, loss on disposal could have been given, and so on. So for the first approach, there are so many things that you could get for free without having to calculate them. But for this question or second method, out of the three, everything, for all the three items, you need to calculate them. But the point is this: whatever you get here as the cash flow from operating, whether you're using the direct method or you're using the indirect method, the amount should be the same. Somebody else prepared the cash flow using the direct. Somebody else prepared the cash flow for the same company using the indirect. The amount of the cash flow from operating should be the same. Okay? So you will allow me to stop there for today. Just introduce the cash flow topic. Maybe next time, in case, we may continue from there now, where we discuss in details. Now, how do you get the cash flow from operating? How do you get the cash received from customers? How do you get the cash paid to suppliers? How do you get the cash paid to service rendered? That's what we may discuss next time. But before we leave, let me talk to some of you. Before we leave, listen. If you want to join our classes, or you have friends who want to join our classes, tell them that we have online classes. tell them that we have online classes for 1. Financial reporting of the intermediate level, financial management of the intermediate level. We have also classes for advanced financial reporting of the advanced level, and we have online classes for financial accounting of the foundation level, or the one for ATD1 and the one of ATD2, same accounting. So if you are friends, or if you are the one here who wants to join our online classes, then we can join, or you can join our online classes any of those 4 subjects. One is the financial reporting of the foundation level, financial management of the financial management of the intermediate, financial reporting of the intermediate. Then we have advanced financial reporting, the advanced level, and financial accounting of the foundation level, the one of ATD1, ATD2. Now, tell your friends, if you are here and you have not joined, tell them that if they can't join the live classes, then they can buy what we call the pre-recorded videos. You can also buy the pre-recorded videos, the whole syllabus, where you watch the videos at your own free time, at your own pace. Okay? Where you can watch the videos at your own free time, at your own pace. And whenever you have a question, you call me anytime. I'll assist you. Okay? So if you want to join the live class or you buy the pre-recorded videos, please call me on this number, 0722 65 8875. 0722 65 8875. For those who need the country code, then you can use 254 722 65 8875. Okay? Currently, we are charging 4,500, the whole syllabus for the whole semester, and we also accept payments on installments. We accept payments on installments, no problem. Okay? Tell your friends who have not joined, or among you who has joined. Good. Now, for those of you, listen to this now. Those of you who are watching this class through the YouTube, please, if you have not subscribed to my YouTube channel, click that subscription button down there and subscribe. Click that subscription button there, subscribe to my YouTube channel, so that you can be notified whenever we post new videos into YouTube. Okay? My YouTube channel is called Joseph Njuguna. That's the name of the YouTube channel, Joseph Njuguna. Good. Also want to believe, also want to believe that you have at least today learned something. So click that like button if at least you have enjoyed today's class. Maybe I could even ask you, those who are there, hope you have managed to enjoy the class for today. If you are watching through YouTube, you can click that like button down there. If you have not subscribed to my YouTube channel, please subscribe. Don't think I've left out anything else about our online classes. Okay? Maybe that's what I wanted to mention about our online classes, which are already ongoing. Those who join, you will get the videos. You get the videos of the classes already covered, no problem. Okay? Those who are buying the pre-recorded videos, you get the videos for the whole syllabus. Those who join the live class, you get the videos of covered classes. Good. Tell your friends about those 4 subjects. If you are friends who are doing this course of CPA, good. Unless there's a question, maybe we could stop there for today. Pick it up from there next time. Unless there's a question or a comment. Somebody has already said thank you. Any comment? Somebody has already said thank you. Unless there's another comment. See you next time. Very insightful. Thank you. Very insightful. Thank you, Joshua. If you have not joined, please join. You will get much more. Thank you, Joshua. You have said it's very insightful, meaning you have understood well. Thank you. Bye for now. Bye for now, unless there is another concern. Well understood or well elaborated, Vincent. Thank you. Fine. See you next time. Bye for now.